Recording this. All right, cool. So welcome to your, their first week of 90-day boot camp. I know you had to cram some videos in since Monday night, but the topics were really short. I think the total about an hour, hour and 20 minutes total. We watched it twice and made 2 hours and 40 minutes, but the topics were really light. Just an introduction to what the Forex is, what the market is, and just a basic idea of how we get started in trading. Didn't talk about any of the technicals yet. All I talked about was who participates in the market. So as you know from your training, the markets are mainly banks. So our banks, major banks around the world, they're the biggest players in the market. And also you have the government. Our government plays a really, really big impact on our market. And then you have corporations, hedge funds, and then the very, very small part of the market is called retail traders. So we are retail traders. We're very, our money doesn't impact the market. We don't have enough money to impact the market. The Forex market is a $5 trillion a day market. So currency gets exchanged every day, and the volume is about $5.4 trillion. It's kind of, people compare it to the stock market. Stock markets are in the billions, not the trillions. But the difference is in stocks, you buy and hold. So you buy stocks or buy shares, you hold those shares. So it doesn't really get exchanged. But in Forex, money gets moved from, like, for example, if I send money to exchange money with Sabrina, we're going to exchange money with Lisa. So that's 3 transactions. So that's all included in $5.4 trillion. So it's really exciting to us because, we want to get a piece of that. We get a small fraction of that for, big market. It's good profits. So what's being traded in Forex? As I mentioned, currency. I'm going to pull up a screen here. The whiteboard. So as you know, our currencies are traded. I'll write them in singles first. USD, which is, what's up, Matt? How's it going? US dollar.
It's going good, thank you.
Good. Canadian dollar. Euro. GBP, which is Great Britain pound. JPY is Japanese yen. Australia. NZD New Zealand. F is sterling. I was gonna meet somebody there. There we go. Sterling, and then we have gold, which looks like this, XAU. So a lot of people will see XAU. That's gold. And then I'm not gonna talk about oil or any exotics. So these are the main currencies we look at. Okay. But what we do is when we trade, we always pair them. So you always see stuff like always trade in pairs. So it's always traded like USD paired with the Canadian dollar. So we call it UCAD or UC. So we're always trading in pairs, regardless if you're buying or selling. You'll never ever see, these pairs are already preset. So one thing that I keep in mind, and what's really confusing people, is when we say we're trading currency, there's no physical money being traded. It's all relative, and it's all what we call derivative trading. So there's no actual money being changed. There's no physical product. We're just trading price. So these pairs are already preset. You'll never see a CAD USD. Doesn't exist. It's always traded in pairs, and we treat them as one commodity. So don't look at them as individual currencies. Look at them as one pair is one commodity, and we're basically trading as commodity going to be higher in price or lower in price. Okay, so yes, that's one example. Another example is Euro CAD or Euro USD. You'll never see USD Euro or CAD Euro. It's always in preset pairs. Okay, so they're always preset. You never see them in different orders. And what they actually mean, and I want to talk about this. I don't know if they talk about this. So when you're buying a currency, so buying and selling. So I'll delete this. Any questions on this first before I move on just the single pairs? Pretty simple, pretty basic. Your videos cover this. Very important though to understand what the pairs are, because a lot of people when they trade, when they first get trading, they try to enter the trade. They're like, I don't know what to trade. They're looking for CAD Euro or CAD GDP. So always know that they're always preset. You always see a USD CAD. You'll never see it reversed. Okay, so just keep that in mind. But buying and selling, very key. To buy and sell. So buying and selling, again, you're not actually buying or selling anything physical. There's no physical dollar being exchanged. All buying and selling means, I'll go with the buy first. Buy really means you believe the price of the commodity. So the price of the pair, I can't spell. Price of the commodity is going to go up. So that's the buy. So what that means is when it comes to a pair, I'll stick with the pair we're going to talk about. So in this group, we're going to talk about Euro USD. It's not the only pair we're going to talk about, but this is what our primary stick with. Okay, the reason why is Euro USD is the most traded pair in the world. It has the lowest spread, which we'll get into what that is. And it moves very nicely. There's no big movements. So it's very easy to trade. Okay, so give me 1 second. Let me pause this to enter a message for a second. There's a pause. Continue here. Hey, Eric. I need to come on. Good. So let me continue there where I leave off. Oh, not there. There we go. Close this. All right. So when you're buying a commodity or a pair, you're expecting price to come up. You're expecting price to go up, and you may not understand what that means. When we go into what is the market, and I pull out, I'll kind of explain to you what I mean by going up. But if you're selling a commodity, you're expecting price to come down. So what does that mean in like layman terms? So if you have a pair like this, Euro USD, Euro USD, when you're buying, so you're buying a commodity, we're expecting the euro currency, to be stronger than the American dollar. So we expect the right side of the pair to be stronger, and the left side of the pair to be stronger, and the right side of the pair weaker. We expect this, there, and there. So as euro goes stronger and USD goes weaker, the charts will be going on the upside, like this. So that's what happens there. You look like an up chart. I'll draw it better. Like that. So that's for a buy. When you're looking for a buy, you're betting on the price of the commodity is going to be higher than where you enter. And if you're looking for a sell, you're looking for a weaker euro and a stronger USD, stronger American dollar. And the charts will look like this. Okay. So the question is, what drives these prices up and down? Okay, what drives them up and down? A lot of it is technical. What that means is technical analysis is basically the study of future or history prices, historical prices. and that we use those historical prices in the future. So what I mean by that is, my example I give is the iPhone. So everyone knows an Apple iPhone, when it comes out, it's going to be roughly about $1,000, right? Now it used to be like 600, but now if an iPhone comes out, we expect the newest iPhone to come out to be $999 Canadian. So we can say that when the iPhone 10 comes out, we know price is going to be, $999. But as the phone gets older, the value drops, the price of the iPhone drops, right? But when the phone first comes out and there's none in stock, people were selling their phones on eBay for $11.99 or $12.99. Price goes up. So the market is created by people, what they're willing to pay for that commodity. Are they willing to pay, more at this given time, or they're willing to pay less for that given time? So we look at historical pricing as saying, hey, in the past, what are people willing to pay, and at what point? And that's how the market's made, by price going up and down, and people buying and selling. But then there's the news. So you have the regular day-to-day technical movement, and then you have news. News is created by our economy. So when Mr. Donald Trump is scheduled to talk, and depending what he says, the market reacts to it and creates movement in the market. That movement, and we'll go on that topic next week, but that movement is only temporarily. That movement is only temporary for that part of time. So I mean that for about 1 hour or 1.5 hour, maybe 2 hour, but it's not long term. And the market always goes back to where it needs to be. So for example, when the iPhone comes out, Apple only has, say, 20 units, for example, and one guy buys 5 of them. After 15 years sold out, he's selling. He's like, hey, I got these phones on eBay, and people are going crazy and bidding for these phones and paying higher price for it because short-term news, right? And then when people are like, hey, that's just too expensive, I'm going to wait for more stock to come out, the market comes down and the price kind of levels out. That's how the market works when news happens. News comes out, people react to it, and they'll buy and sell for ridiculous prices. But that's going to next week's topic. This week we talked about market participants. We talked about who's involved. What is Forex? It's currency trading, and what's being traded in Forex is these 8 currencies. Then we talk about PIP. Everyone hears me say 30 pips a day makes a day job go away. I want to get into that, and then leverage and lots. Any questions before we move on to pips?
Oh, sir.
All right. Lisa, does that make sense to you? Lisa's the one I'll pick on today. Lisa, you there?
You better speak up, Lisa. He's relentless.
I am. Lisa's either away from the phone. Oh, she's messaging me. Maybe her kid's sleeping. Oh, okay, kid's sleeping. Delma, that stuff make sense to you? What the Forex market is and what it contains? You're on mute, Delma. Let me unmute Delma. There you go. Hey, Delma, we can hear you now. There you are.
Okay. Like whenever you said you were buying pairs, is that kind of like buying a position?
Yeah, so that's a good point. Very good question. So we open positions. So when we trade, we open positions. So it's called an open position. It's either a buy. Okay, so when we open a position on a buy, so whatever that price is in that market or whatever that commodity is worth is what we get into.
Mm-hmm.
And based on when we close the trade or when we get out of the trade, where that price is relative, is determined as we profit or loss.
Mm-hmm.
So the market moves on a buy or on a bullish market. Market goes up like this.
Mm-hmm.
And for example, if we enter the market here and on a buy order, so on a buy, like so, what we're saying here is we expect price. We're betting on price of the commodity to go up.
Right.
Okay. So if we got into this where the circle is, and then market came out and we exited here. Oops. We exited here. Then we're going to make the profits between here and here.
Mhm.
I'll show you what that looks like on numbers and how that works. But say we entered, we opened a position, we entered a buy here, and the market reversed and came down, and then we exited here. We're now exiting at a loss.
At a loss, yeah. Yeah. Okay. That's clear.
So the question is, what is a pip, and how do we determine what's a gain, what's a loss? Okay, I mentioned relative where you entered and where you exited, but I said, can I go back? I can't go back. Let me draw it again. So I mentioned if we entered here and we exited here on a buy, so on this buy, oops, where did I push? Sorry, let me close this. Push, there you go. So on this buy, the difference here to here is measured in pips. Okay, so I got a picture here. I'm not sure you can
What's
see.
the acronym stand for?
Price of interest.
Okay.
Okay, so can you see this? Let me stop the share. Let me reshare this. Okay, so this is the Euro USD. So when you go to the currency exchange, some guys saw me post a currency exchange. In the market, we only see 1.10. Okay, or in Canadian dollars, USD is 1.24. In the Forex market, we move 2 decimal points, 1.1051. So we trade in the thousandth decimal point. A pip is this 1,000th decimal point. In Euro USD, in the market, you'll see a 0 here on this side. This number is invalid. The pip starts on the thousandth so the 4 points of the decimal point. 4 rights to the decimal point, so it's 1,000th of a decimal or a penny. So we're trading less than a penny. So as this price changes, our price goes up. So let me give you an example there. Back to the whiteboard. So I think it was 1.100104. Let me see. 105, so 1.05. 1.05. Oops. 1054. There you go. Okay. So this is your pip. This number here is your pip. And say this is where we entered. Just as this is where price was. Yeah, this is only an example. I'm not sure what price is today. But just so we exited here and the price was 108. Okay. So the price difference between here and here is 7 pips difference.
Mm-hmm.
Okay. So we're making 7 pips profit. Okay. And again, if we entered the opposite way, just so we had a sell order, and we expect the price to come down, then it would be a 7 pip negative. That would have been a 7 pip negative. Does that make sense? How pips are calculated? Lisa? Sabrina? So
Yes.
a pip
Sure.
difference between Delma's okay there. I'm gonna mute Delma for a bit. Okay, so a pip is a difference in price. It's the 1,000th decimal point. Got a question there? Okay, perfect. So when I say 30 pips a day makes a day job they go away, we're looking for a difference in 30 points between here and here. So that would be 8-1. So that's what we're looking for in your trade. But the beautiful thing about pips is you don't have to catch it all in one trade. You can catch it in multiple trades. Oh, let's change. 181. There we go. Question. Yeah, Matt, I'll send it to you after. That's what we posted. So it's very important to understand what a pip is, and we try to catch 30 pips a day. Oh, I can't leave this. All right, so let me clear all this. Perfect. So the calculations for pips to dollars, very important, is dollars equal to number of pips times 10 times your lot size. Okay, we haven't talked about lot size yet. We will in a second. But understanding number of pips is very important because that's how you make money. So number of pips, I want to say, we said 7 was our number, times 10 times the lot size example I'll use is 1.00. A lot of people misunderstand this for $1. This 1.00 lot size is actually one lot. It's not actually a dollar. And I'll explain to you what that means. But in this example, the dollar amount is, so 7 times 10 is 70. Okay, times 1 is 70. So in this trade of 7 pips, you're going to make $70. So my example of 30 pips a day makes a day job go away. We'll use the same equation. Dollar equals 30 times 10 times 1, which is equivalent to $300. Okay. So the biggest question is, how does 7 pips make $70, or how does 30 pip make $300? That's the big question, because we're trading in thousands of a penny. Okay, so price changes less than a penny, but yet we're going to make $300 or $70. Like, how is that possible? That doesn't even sound right, right? Let me explain how that works. Everything has to do with the lot size. Okay, lot size is key. As I mentioned to you, lot size here is not $1. Lot size is everything. The power of trading is all in lot size. Lot size 1.00 is actually called a standard, which is equivalent to 100,000 units of currency or commodity. Then you have 0.10, which is a tenth of a lot. They call that a mini, not 10 cents, and that's equivalent to 10,000 units. And then you have what's called 0.01, which is called micro, which is 1,000 units. So when I open that call, that order of one standard, I'm actually opening, I think the example was Euro USD was at 1.1051. So I'm opening, the order look like this. It'd be Euro USD buy, I'm running out of time, buy at 1.1051. So that's the order. What this actually means is, let me edit this. Sorry, I just got a message that this Zoom's going to end in 10 minutes. Is 1 point at brain dump there, 0.00. Okay, that's what it looks like. What that means is you're going to buy 100,000 units of Euro USD at 1.1051, which is equivalent to 100,000. So it looks like this, 1.10510. So you're actually going to spend $110,510 to open this position, because you're going to buy 100,000 units at this price. So the next question is, okay, that's great, because now you have 100,000 units. So when it changes from 1.1051 to 1.1058, which is a difference of 0.0007, 1 pip, is because you're going to multiply this by 100,000 units. Okay, and that's what gives you $70. But the question is now, how do you have enough money to buy $110,000 worth of currency? Because I don't have $110,000 of currency or money. You know, Eric might, Delma might, Matt might. I don't. I don't have $100,000 to throw at this. And they told me that I can get in cheap and trade with a fraction of that cost. How that works is called leverage. We leverage the broker's money. Okay. We leverage the broker at 500 to 1, 200 to 1, or 50 to 1. 50 to 1. And I apologize. We may get kicked out in 7 minutes. I'm going to try to go fast. I'm using a free version of Zoom as Chris is using my other Zoom. So I didn't realize it's limited. I'll fix that for next call. So if your account balance is $1,000, for example, your available credit to you or available funds to you, funds available, is actually 500 times that. So 5, 3, 1, 2. So you have $500,000 available to you. You're not. It's not a loan. If you think, oh, this is a loan, it's not a loan. You're just leveraging the broker so they buy more currency to open a bigger position. So now you have $500,000. Opening a $100,000 position is doable. Okay, but the most you can lose if you ended up losing a trade is this $1,000, because currency would never be $0. You'll never have a currency that's worth $0. You have a price difference, but you'll never have a $0 price difference. Like you'll never have a $0 currency, so you'll never lose more than $100,000. See, the broker only allows you to lose up to what you have in your balance. But the good thing about this now, you open a larger lot and you can trade at bigger units to make profit. That makes sense? There's got to be a lot of questions about this. Please give it a second to think about it. I want to answer this phone call really quickly because he called twice. But any questions there? No questions?
No.
All right, cool. So last topic I want to talk about really quickly is a trend. That was your last topic of your training. A trend is basically the direction. The direction of something that for a long period of time, right? So in the markets, quickly to this. Just want to go trading real quickly. And we'll talk more about this on the video I do tonight. I want to send you guys a video to cover more material. But understanding lot sizes is so important. So see how on this chart here, okay, the market is moving up for a long period of time. This is a trend. That was an uptrend. And then you have down here a downtrend over here. Trends are very important because we always trade with the trend. So the market's coming down, we're going to sell majority of the time here. When the market is going up, we're going to trade or buy majority of the time here because we know the market's going towards a higher price, so we're going to buy. Over here, we know the market's going down, so we're going to trade. We're going to sell in this type of trend. So identifying the trend is very key I'm not going to teach you how to do that today. I just want you to understand that trends happen day in, day out. You can see this chart here. There's a downtrend, a little bit of uptrend, then a downtrend. There's the market. All it does all day long. Oops, wrong share. Share, whiteboard. The market, all it does all day long is this. Up, down, up, oops, up, and then down, up, down. So that is all day long. It goes up and down, up and down, up and down, up and down. Sometimes up is longer, sometimes down is longer, sometimes up is shorter, down is shorter. Our job is to determine which way we believe direction is going to go and make that trade. That's what technical analysis comes in. This is where we find out, where we can catch our profits. So in the next 90 days, you're going to learn how to determine where price is going to go and where to enter in the market, a buy or a sell, so that you can earn that money. Last week or Monday, I talked about how you can grow your account. You can grow it for big daily income. You can grow it to make a passive, retirement fund. You can grow it different ways and different methods. And every person has a different goal. But I'm going to teach you these ways on how you can literally do what you wanted to do. So for myself, I trade 6 accounts. 4 of them are passive for my kids, my mortgage, and my retirement. 2 of them are aggressive, my salary and my wife's salary. So I trade 6 accounts at once. So I want to teach you this skill. I'm not going to teach you how to make money. I'm going to teach you a skill so that you can make money. Okay? That's enough time for today. I'm at 2 minutes left before it actually cuts out. I thought I had a full hour, so I do apologize for that. I'll record this. I'll post it on my YouTube channel. I'll send you the link. But there's got to be a lot of questions about leverage, pips, buy and sell. So please do ask. I'm going to do another video after this and post it as well to go into depth about trends and give you really a good idea of different trends and how we identify them. Before we get into the next topic, I want to send you an email with the next videos is support and resistance, identifying trends. We're going to talk about this for 2 weeks. The 2-week topic. Traders don't learn enough about support and resistance and zones. IML does a really bad job explaining it. I'm going into depth and into detail about support and resistance and price zones, but that's where the money is. Trading is just support, resistance, and trends. That's all trading is. Everything else is just the little gadgets and the little bit extras. You don't really know. The only thing you need to know is support and resistance. So I'm going to really go into detail on that for 2 weeks. Because once you get a good understanding of that, you won't lose money. Excuse me. Okay. No, thank you. All right. Well, it's going to cut me off, so I'm going to say good night for now. Please, on the WhatsApp, ask questions and rewatch this video. You have to. Okay?
Thanks, sir.
All right. Have a good night, everybody.
Bye.